Hi, welcome to Challenge JP. My name is Jacek, and today I'm going to show you how to create a merger and acquisition financial model in Excel.
Let's start with a general structure of the model. So what I assume is that we're going to deal with two companies that eventually we want to combine into one, either through acquisition or a merger. And the way that the model is structured is so you can see the state of the two companies before the acquisition and then post-acquisition. Okay, so this is where you will see those two columns in here. And I simply will start with showing the main metrics of the companies itself. So this is just an annual summary, and in a few moments I will go into monthly calculations. But you will see that I assume that, okay, I have two companies here, which I could just call Company A and Company B. They have two different addressable markets, and then also they have already a customer base. So they're already functioning companies. And what I want to show is the state of these companies before the acquisition. So that would be the number of addressable customers they had before those two companies were combined, and then afterwards. Okay, and this will apply to other metrics as well. So you will see that I have my addressable market again, my customers, and then I will proceed to showing the revenues, non-recurring revenues, and one-off revenues, and also recurring revenues. So the ongoing revenues that those companies have. So for example, if you have the company here, Company A, we will assume that if this is an acquisition, the Company A is the company that acquires the Company B. Okay, so we'll just show the revenues of the Company A before the transaction, and then how those revenues will evolve after the transaction. And then here for the Company B, we'll assume that, okay, well, this is the revenue this is the revenue of Company B before the acquisition. And then this will be the synergy gain, okay, that the Company A will get as the result of the transaction. So the way to look at those numbers is always to see that, in a way, how the Company A would look like, how the revenues of the Company A would look like before the transaction. So if it was just going on by itself, and that's the additional, for example, in this case, revenue that's a result of the acquiring the Company B, and therefore this is the synergy gain. And then here you will see the total recurring revenues of that company. Okay, and going forward, I will use exactly the same logic for my cost, for example, here. So here I have my variable cost. So again, I will show, okay, what was the variable cost of the Company A before the transaction? What would be the ongoing cost of that company without including the cost of from the Company B? And finally, I will show here the synergy gain, or what was the cost of the Company B before this company was acquired, and then the overall cost, for example, for the customer support for those two companies combined. Okay, I'll do that for my variable cost. Again, I will get to the details of how I calculate each of those costs later on, but that's just an overview to give you an idea of the structure of the model. That gives you a variable cost, and then you will see I'll get also to my headcount calculation. So the way I will divide the headcount would be into dividing the what I call here a variable operational headcount, which is more driven by the revenues or the number of customers that you get in a company. So this will differ depending on your level of growth. Again, showing that for those two entities. And then I will get to a calculation of central headcount. So for example, in here, you will see some synergies or some savings actually in the central headcounts, assuming that you don't need to transfer all of the employees from the previous company to a new one. Okay, so this is where you will see that there will be some savings for your costs. Then the same thing will apply for other expenses such as office, general expenses, and then finally the overall cost here. Then just the calculations of EBITDA. There will be some CapEx calculations. I will assume here that as the result of acquiring of a new company, you will need to add some additional CapEx, for example, that we'll spend on new system or migrations and so on and so forth, anything that you can capitalize in this case. Then there will be some tax calculations, working capital, which will finally allow us to calculate the unlevered cash flow. Unlevered cash flow here is just the cash flow before any debt injections. I will assume, this model will assume that you can also add some debt to finance some of the capital required to for the acquisition, for the transaction. So this is the calculation that you will see in here. So in this part, we'll calculate the debt drawn, so any additional debt that you add into your company, and then also the principal repayments. And then overall, over here, you will see the debt fees, interest expenses, and then any tax adjustments if you can include the interest that you pay in the tax calculation. So this will give you your lever cash flow calculations. And then you will see that I also have some calculations for the profit and loss statement. In here, a lot of that will be just repeated from a lot of those numbers will just repeat themselves from the cells above, but eventually you should be able to calculate the net income. You'll see here that I will add some depreciation calculations, which will have an effect on your net income below. Then finally, the cash flow statement, so cash flow from operations, investment, and then financing. Then balance sheet calculations. So this will be just an illustration of example of how you're going to transfer some of the assets or liabilities from one company to the other and consolidate them into one view. So we'll deal with the assets here and then liabilities in here. I will talk about things like fair values and also goodwill calculations. One thing to add, and this also applies to, basically all the calculations in this tutorial, is that this is just an illustration. The merger and acquisition accounting can be quite complex, so you should always consult the rules that would apply to your particular transactions. And then finally, I will get into those fair value calculations and also the goodwill calculations here, and analysis of return on investment. Okay, so we want to be able to value the transaction and see whether our acquisitions actually make sense in terms of the financial metrics or financial returns. So that section here will allow you to calculate your IRRs and your NPV for those transactions. And then below here, you'll see there's just the summary of our debt calculations that I mentioned before. Okay, let's have a look at the financial model and monthly calculations. You will notice that this sheet follows the same order or the same structure that we look at in the summary sheet, but it will be more detailed. You will see that I've added some numbers in the columns A and B. Those are assumptions that are applicable to calculations from each of those rows. And then if you click on any of those assumptions or any of those numbers, you'll see that they are linked to the summary sheet here. So for example, this assumption, let's say this assumption here links to the summary S16, which is our assumption in here, S16. So you will see that the way the model structure is that you have assumption table in the summary sheet here. So this is the table where you put in your assumptions, your inputs, and then those are carried over here, and then you can see how those assumptions are being used. Okay, so similar to what we saw in this summary page, you'll see that the first 12 months, so the first year, shows the performance of those two companies separately. So you see, for example, in terms of the addressable customer market, how the company A performs, and then the company B, and then anything after month 12, so starting from the month 13th, that company B lines that becomes your synergy gain or savings that you get as the result of the acquisition in our case, or a merger. And then finally, that number here is the combined number for those two companies. Okay, so the way to look at that is to, for example, look at month 12, and you can see that, all right, so in month 12, my company A had an addressable customer market of 100,000 customers. The company B had market of 50,000 customers. So now if the company A acquires company B, the combined market of this newly created company is 150,000 customers. Same thing with, for example, our end of month customers. So you see that company A had 9,000 customers in month 12, then in month 13 would have 9.7 thousand, just 9.8 thousand customers if it continued to operate as a separate company. Now we see that there was a bit of a gain coming from the synergies from combining those two companies together. So you get additional 3.5 thousand or almost 3.6 thousand customers, and therefore you combine number of customers is 13,000. All right, so that logic applies throughout the rest of this model, and this is a nice way to show the effect of that combination, the merger or acquisition of those two companies. In terms of the revenues, you will see that I'm using the some of the assumptions related to, for example, the monthly fee for each customer. So this model assumes that it's a customer-based model. So, for example, it could be a model that relies on customers paying a monthly subscription, but you should be able to adjust it. For example, if you don't want to use customers, but for example, number of products sold or any other metrics that you want to add, you can just change those metrics a little bit and it should still work for you. So here, for example, we're assuming that each customer on a monthly basis generates $20.6. And the way that the revenue is calculated here, you simply take the number of customers and then you multiply it by that monthly fee, okay? And that applies to company A and then company B. In our case, I assume that those two companies were charging the same amount of money for the monthly customers, but you can obviously change that. You may have two companies that have a different pricing structure. You will notice that I also have something called non-recurring revenue or one-off sign-up fee. Those are zeros at the moment, but you may have a case where, again, in the subscription model, for example, you may have a sign-up fee where a customer, when they join the service, they pay some fee, just one-off fee at the very beginning, and then they continue paying the recurring fee. So this is the section that you would use. Okay, and then again, that allows you then to see my synergy gain. So for example, if we take the company A again, in the month 13, so January 2023 in our case, the company A's revenues would be 185,000, but now we've also adding that synergy gain, which is the result of the transaction of acquisition. So we're adding 72,000 in revenues, and therefore the combined revenue of those two companies would be 257,000 or almost $258,000. Okay, and then here, for instance, I'm calculating some variable OPEX. So that would be a customer support or customer acquisition cost. And then in here, I'm using slightly different approach than I used in my pricing. So here I'm assuming that actually as the result of acquiring the company B, we managed to create some savings for our cost. So for instance, before the acquisition, the company A's customer support cost was $2.50, and then company B's support cost was $3 per customer. Now we believe that after the acquiring of the company, after the acquisition of company B by company A, you can use the same cost, customer support cost per user. So you can actually lower those costs for the customers related to a company B. Similarly, for the cost per acquisition calculations, so here we assume that before the acquisition, the company A's CPA was $100, and then company B's was $75. What I'll assume here is that after company A acquires company B, those costs will be actually the same. Okay, so that you will actually increase the CPA for the customers from the company B. One thing to notice is that you also see that there was a bit of an increase from month 12 to month 13 for the cost. That's actually related to inflation. So you'll see that on the every 12 months, the price, for example, the cost here will increase from 250 to 255, which is the 2% increase that we assume in this model. Again, this is an assumption that you can change and you can adjust. Okay, so as the result of having those inputs for your customer support and customer per acquisition cost, you can then calculate the numbers, and therefore you will see that the way it works, you take your 255 customer support per user, for instance, and then you multiply it by the R38 cell, which is just the number of customers at the end of the month. Okay, so you take the number of customers and you multiply by whatever input you had in here. And then similarly, to calculate the acquisition cost, you take the number, you take your CPA, so a cost per customer acquisition, and then you multiply it by, in this case, number of new customers. Okay, that allows you to calculate your total variable OPEX. I also see that I've added here something that I call payment processing or bad debt. This is basically just the cost, which is calculated as the percentage of the revenues. So the way this cost is calculated, you simply take the percentage here, so for example 3%, and then you multiply it by your overall revenue. So let's scroll here below, and then you will see that now we have variable headcount calculations. So in here, I assume that in order to calculate the number of operational heads, so those will be the employees that support the customers, and this number will vary depending on the number of customers that you have. So for example, here, I'm assuming that for every 1,000 customers, you need one additional headcount or one additional operational employee. So the way that formula works, you take the number of customers in here, so almost 10,000, divided by 1,000 here, which is again just the assumption in the model, and then the result of that is 10. So I'm using that round up formula, so you're just rounding up to the nearest number, and the same thing will happen for that company B, or in order to calculate any synergies, and that's the total number again of the employees. Now I also have the average staff costs. So here you'll see that staff costs done on the annual basis, which then in turn allows you to calculate the overall staff cost. So you just take the number of employees and then multiply by that monthly cost. Okay. One thing to notice is that staff cost includes all the costs associated with the employees, so it's fully loaded. So any taxes or any insurance that an employer has to pay. If you want to, you can separate those costs into two lines. So you will just simply have just the salaries itself, and then additional staff costs as two separate lines in here, and then you should also get to that final number for the variable staff costs, which then in turn allows you to calculate the variable OPEX plus staff, and then eventually you can calculate your gross margin. Now let's move to our central OPEX calculation. So what we have here is a slightly extended table, but this tables here shows you the structure of the headcount of the employees for the company A and the company B before the acquisition. Okay, so we want to do in here, we want to say, okay, what happens to the company A after it has acquired this new entity, which we call here a company B. So the way this model works, you just look at the structure of the two companies, and then taking the company B, we want to see how many of the existing roles we want to carry, we want to transfer to the new company. Okay, so it just says, okay, let's say that in my central, for my central employees, the company B, so the acquired company had 3 people in the management. Well, probably we don't need all of them, so we will carry 1, and then the other 2 will will be made redundant, will be let go, for instance. Okay, same thing for example, finance. The company B had 2 finance people. Well, we probably just want to keep one of them, because we remember this is the additional number of employees that we carry from company B. Okay, so this is in addition to whatever employees we had in our company so far. Okay, and the same thing here. For example, you can in this case you may say, okay, well, actually sales and marketing, the company B had 1 person. We actually think that because we want to expand that customer base, we need to bring 1 additional person in here. Okay, so it's not necessarily a saving. You actually have to add more cost, right? And the same thing for operations. You can see, okay, we actually had 2 people, but now we're just going to need 1 because we have our own operational people. So you basically, as the result of going through those different roles, you decide that, okay, of the 9 people that the company B, we just need 5 of them to be transferred, to be added to our existing structure. Okay, then for each of those roles, I have my average staff costs. Okay, so which are listed in here. You'll see there is again a little bit of an increase from month 12 to month 13, which is a result of adding a bit of a inflation or salary increase, which is done on an annual basis. And then finally, I can calculate those additional costs. And then here, if I just unhide those rows in here, you can then calculate also the cost for company A, which is also just a multiplication of the number of employees times the average salary. And then that then allows me to calculate my central staff cost structures for all of the employees. In addition to that, you'll see that I also have some office cost calculation. So you see here, I'm simply using the number of employees and then multiply it by an average office cost per employee. Again, you see that the company B had actually a higher average office cost per employee, but after we combine those 2 entities, this average cost per employee will go down. We'll just assume the same cost as for the company A. And then you have some other general expenses. So this is the place where you can add any additional costs that your company incurs on a monthly basis, which then in turn allows you to calculate your fixed cost. Then you can combine all of those costs into central staff and fixed costs, and then you have your EBITDA, which is simply your gross margins minus your central staff and Opex. I've also added a section here for CapEx, and this allows you to calculate any additional cost, assuming that you can capitalize it, that would be related to acquiring the company. I've also added some working capital adjustments. So those will be this is the line which is related to payable and receivable movements, which finally allows you to calculate your cash flow. And then if we keep going, I've added some depreciation calculations. So those calculations will be important to when we calculate the P&L, and then also some tax calculations. Okay, so let's go back to our annual summary. So again, you will see that here I use the sum ifs formula in order to aggregate all the numbers from that monthly financial model sheet into this view. And the way that sum ifs formula work is that you take the relevant numbers. So for example, here would be the row that's related to the recurring revenues, and then you only aggregate or sum the numbers that match year 2025 as its criteria. Okay, so this allows us to calculate the unlevered cash flow, which is in here. So this is the cash flow before the debt. And then you see that I've added here also some debt, right? So I'm assuming in this model that you should be able to, or you have an option to add a debt in order to finance some of the money that you will need to spend to acquire this new company. Okay, now the question is, how are you going to estimate the amount of money that you need to spend on acquiring the company? So if I scroll down through my model, you'll see that I get to profit and loss statement. my cash flow and balance sheet, I will eventually get to the fair value estimates. So the way I estimate the fair value of this model is based on revenues of the acquired company, so the company B. And in this case, I simply take the revenues from the company B. In our case, those revenues will come from the cell over here. And then I multiply this figure by my multiplier in here. So I'm using the revenue as the base for the fair value valuation. Again, it's just one of the methods of trying to figure out the amount of money that you would be willing to pay for a company. So you see that I'm using here the multiplier of 28.6, but again, you will have to adjust that figure depending on the industry that you're targeting, the market, and also the market conditions. Okay. Now, in addition to that, I also adjust that figure by any cash and net current assets that the company B has on its balance books, on its balance sheet. And then I also adjust any debt and liabilities that this company may have, which then allows me to arrive at that figure of 12.02 million. Now, in addition to that, the calculation also allows for adding some premium. That would be the percentage that you want to increase that fair value estimate by. So in this case, for example, in my model here, I set it at 30%. And the way the calculation works, you simply take that 12 million and then multiply by 30%, which then allows you to arrive at that figure, which is the payment for acquisition. So this is the amount of money that you actually would pay to the company B in order to acquire it. Then, in addition to that, I've also listed costs that would be generated by the company A. So if I were to be the acquirer, that would be the cost that would be generated by me. So I'm taking into consideration some costs that I will have to pay for migration or for integrating of the company B into my current structure. And I've also added some debt fees and the initial interest payment. So this is the interest that I expect to pay in the first year after the acquisition. That simply allows me to calculate the total cost in the first that I would incur in the first year after the transaction. Okay, and then below here you see that I divide this figure into two parts. So the debt part and the equity. The model assumes that you'll be able to pay for the acquisition through the combination of debt and equity financing. And so, for example, in our case, we would assume that you would pay 60% for the transaction in debt. So this is that 10.5 million figure, which is that 60% of that 17.6 million, which is the total capital required to pay for the transaction. And then the 7 million will come from the equity. Now, since I'm drawing some debt, I also have to add debt calculation, which I did in here. So I will simply take that number of 10.5 million, let's say dollars, okay, as my debt that I will raise in 2022. So just a year before the transaction, and then I will use the PMT formula in Excel. So this is the formula here in order to calculate a total payment that I need to make on a yearly basis to pay off the debt over a period of time. So in here, you'll see I'm using assumption 10. So I'm assuming that I will repay this debt over 10 years. And that, along with my interest assumption, allows me to calculate that payment figure. Okay, so the way it works, you will see that as long as that year number is less or equal to the number of years that I'm repaying the model, that means that I still want to use this formula. Otherwise, it will just default to a 0. So in the years when I'm repaying the debt, I'm using that, again, PMT formula. And the PMT formula simply allows you to insert the rate. So in our case, is that 8%, so it's that interest rate. The NPER number, this is the number of years over which I want to repay the debt. So in our case, it's 10. And then that PV number, which is the present value. That's simply the debt that was initially drawn. Okay, so based on that, you can see that my total repayment is almost $1.6 million dollars, and then of that, looking at the my opening balance, I know how much of that payment will go into an interest payment. That's simply by taking the my number here, so my opening balance times that 8%, which is that interest percentage figure, and then the remainder. So, and difference between the total repayment calculated with the PMT value and the interest goes towards my principal repayment, which you will see in here. Okay, so that closing balance, my debt closing balance figure, will be subtracted by that principal repayment. And the way that to check that the model works is that if I had 10-year term for my debt, I should see a 0 at the end of year 10. Okay, because I should repay my debt in total, which you can see in here. Now let's see what happens to my equity. Okay, so we said that of that 70 million, just over 17.5 million, 10.5 million will come from debt, and then the rest will come from the equity. So we want to see actually what is the return that I'll get on my invested equity in this transaction. And this is where this table here will come handy. So you see that here I listed a few things. So I want to look at the returns just for the company 8 pre-acquisition, and then the incremental returns that are just related to the acquisition itself. So any part of the cash flow that comes from acquiring that new company, and then also the overall returns. Okay. Now, what I have in here, I've listed the invested equity. So here I just list the total equity that has been invested before the transaction occurred. And here you'll see that in 2022, I raised that 7 million in order to finance the acquisition. Okay. Now, what I did in here, I assume that after 10 years, I want to be able to estimate my terminal value or the exit value for my company. And in order to do it, I will simply use the EBITDA as the basis of my valuation. Okay. So in here, I took the EBITDA of the company A, but again, I split that into the parts that are related to the EBITDA of the company A pre-acquisition. So what the EBITDA would look like if it didn't acquire that company B. Then I have my EBITDA, which is related to the acquisition of the company B. Okay, so what we're saying here is that my total EBITDA in 2032 is 12.5 million. Of that 12.5 million, 8.2 million would be related to the original company A customers, and then the 4.3 million is related to the transaction, the acquisition, so the customers that were brought in for the acquisition. And if I'm using the EBITDA as my valuation method, I will simply take that number here and then I'll multiply it here by, for instance, 10. Again, that 10 number is just an example of a multiplier. You may have to adjust it depending on the market or the industry that you're using. I'm just using the 10 here for simplicity, okay, as an illustration. So that allows me to say that at the end of the year 2032, my company will be valued in total at 125 million. Now, that figure I'm going to adjust for any assets and liabilities that I may have in the company. So, for example, in here, in those two cases, I have quite substantial level of current assets, such as in both of my companies. I'm going to add that number to the valuation. Now, if you add that debt that we've repaid over 10 years, you would also have to include the debt in this calculation. So that would be a negative adjustment. And then that allows me to say, okay, well, finally, this will be the exit proceeds that I will receive if I were to sell the company, for instance. Okay, so so the company would be worth 184 million. Of that, you will be able to attribute almost 120 million to the original company A, and then 64 million to the acquisition of the company B. And hence, based on those numbers, if you take your initial investments here, so that 19, almost 20 million of the initial investment that was put into a company A, and then that 7 million that was used to fund the acquisition of the company B. Again, this is just related to the equity. Based on those numbers, you can calculate the IRRs. So the IRRs in Excel, you simply use the IRR formula. As the initial number, you take the investment, and then you look at the exit here. So this gives you an IRR of 17.8%. Then the IRR of the acquisition transaction is actually higher, so it's 24.7. So again, you look at, okay, we invested 7 million and we got 64 million after 10 years. So that results in annual return of 24.7%. And then therefore the combined return is 19.6%, which you can see here. Okay, so that's again, it's just taking those numbers combined. And then for the NPV, I'm assuming here that the discount rate is 10%. So based on that, you can use the NPV formula, and then you use exactly the same inputs. So you're taking the initial investment and the exit here. So the money the proceeds that you will receive for the company A, and then for the portion of the company A related to the acquisition, and then the combined NPV of those two. Let's now see how I approach the balance sheet. Again, as I mentioned before, the accounting for acquisitions and mergers can be quite complex. So this is just an example or illustrations. So you see here, for example, in 2022, there was a substantial increase in cash related to company A. That's because I've added in here the cash that is needed for the payment of acquisition, which is here you see is linked to my cash flow statement from above. So that's the reflection of that, and then you'll see that cash will then decrease as the result of the acquisition because I had just paid for the for this new company. I'm assuming that any accounts, any assets will simply be transfer over to the new company. So you will see, for example, here in terms of the long-term assets, the company A had a long-term assets of 80 million. I transferred those assets over here. Now I'm also making some adjustments for the depreciation here to get to my net position. Now for the company B, I'm also assuming that I will transfer the company's B long-term assets, and I'm also added here that 1 million, which is related to the to integrate the company B into company A. Now, one thing to notice is that you will see that there was this fair value adjustment. Okay, and what this fair value adjustment is simply the difference between the fair value that I calculated previously of the company B and the assets that I transfer. Okay, so in this case, you will see that I'm taking the value from the cell 318. We arrive at the figure of 11 million. So if I just take a look at the company's A's long-term assets, that was 81 million. So I need to include that 2.9 million as my fair value adjustment. Okay. Now, in addition to that, you will see that I also have a goodwill adjustment. So this adjustment would be related to premium that I'm paying for the company. So again, as I mentioned in the previous part of this tutorial, I'm also assuming that I'm paying some premium over the fair value for the company, and this premium that I paid will be reflected in here. In terms of the depreciation, I'm depreciating the assets for both company A and B, and I'm also adding the depreciation for the fair value. That figure will come from P&L above. And that eventually allows me to calculate my long-term assets and the total assets. And then in terms of the liabilities, again, I transfer most of the liabilities to the new company. Now, one thing you will notice here is that company A has the 10.5 or 10, almost 10.6 million of debt. That's the debt that was raised in order to finance the part of the capital required for the acquisition of the company B. So that stays here, but then the repayment, so any principal repayments related to this debt are then allocated to the company B, or to the synergies related to the acquisition of the company B, which allows you then to illustrate the impact of the acquisition. In terms of the owner's investment, you see that my initial investment in the company A is now increased by that equity investment that I used to finance the acquisition. The company B's investors are fully paid, so I'm not transferring any of the investment from their balance sheet, so I'll keep it at 0. And then for the return earnings, I'm not transferring any return earnings of the company B. I'm just basically going to start adding those earnings from the moment from which I acquired the company B here. And then that allows me to calculate finally the total owner's equity, total liabilities, and owner's equity. And then, as always in the balance sheet, make sure that the assets and those liabilities and owner's equity do balance. Okay, now let's move a bit up here and then very quickly look at the cash flow. So I put together the cash flow statements. Most of the figures here are from the P&L above and the financial model summary in order to get to the cash flow from operations. Now you will see that my cash flow from investment reflects the payment for the acquisition. So this is the figure that we discussed previously in this tutorial, and also any cash flow related to that migration or integration, for example, of the two companies. And then in terms of the cash flow from financing, again, you will see that there was this new debt coming in linked to the debt calculations below, and then the principal repayments, and then you also have that equity investment, so the portion of financing needed from the equity. Okay, if we scroll up further, you will see that here we have our net income. So I try to structure the net income in a similar way that you have our cash flow. So you see the part of revenues and costs that are related to just the company aid, and then the synergy that is related to the acquisition. Now you will notice that here I've added the depreciations for the assets of company A and company B's, but also the any fair value adjustment. Okay, so remember in the balance sheet we were doing some adjustments to the fair value to account for the difference between the value of the assets and the valuation that I did based on the revenues, and this is where you will reflect that depreciation of that fair value. And then in addition to that, you'll see also I've added some expenses related to the debt, and then any adjustments for the tax. And this eventually allows you to calculate that net income. And what's important is that you want to make sure that you linked the net income to your cash flow statement, and then the cash flow statement is eventually linked to the balance sheet. So the change in the numbers in one of the statement impacts the other two. Now let's go back to our summary. Let's scroll all the way up here and very quickly look at the assumptions and the returns. Okay, so again, as I mentioned before, I've listed all the assumptions to the right of the summary, and the reason for that is that you want to be able to quickly see what happens if you were to change one of the inputs. So for example, let's see what happens to my revenues if I were to change my fees. Okay, so at the moment we're assuming that your monthly fees would be $20 per customer. So let's see what will happen to those revenues if I were to change that number to 15. Okay, so you see that before here was 21 million. So let's go back. Yeah, so my revenues in the last year of this model was 21, almost 22 million. If I were to change that to 15, those revenues will drop to 60 million, which makes sense because we've dropped that monthly fee by 25%. Okay, let's go back. And then you can, for example, check, okay, well, what will happen? We have some assumptions here around the target market reach. So what will happen to my returns if I were to change that reach from 45% to 30%? Okay, so I'm actually not going to reach as many customers from this addressable market base. So again, the 19.6% changes to 14.5%. And then, for instance, if I want to see, okay, the combined effect of lowering the market reach and then the change in pricing, you will see that, okay, now actually my returns drop to 7.1%. Okay, so that exercise allows you, that sensitivity analysis allows you then to find any weak spots in the model and see where that model breaks. Now, to the right, I've included here Excel data table, and I want to see, okay, how my debt leverage, so debt leverage being the percentage of capital that I need for the transaction that is financed by debt, how that debt leverage and let's say the premium that I'm paying for the transaction impacts my IRR for the transaction. So you'll see that as I'm increasing the premium, my IRR decreases, which makes sense because your initial investment for that new company is higher. But as you increasing your debt leverage, your returns are increasing. Okay, and then the other table shows you, for example, that post-acquisition IRR, so that 19.6%. So it looks into, okay, what will happen if I were to increase my CPA, my cost per acquisition. So you will see that as you're increasing this cost per acquisition, your returns are slightly dropping. But then, as we saw also previously, let's say if we keep my cost per acquisition at $100, you can see, okay, what will happen if I start increasing or decreasing my market reach. Okay, so you see that while the change in CPA does not seem to have a massive impact on your returns, the changes in market reach do have quite an impact on your final returns and the feasibility of the model. And then finally, I've also added some graphs in here, which are linked to the summary page. So this allows you to, for example, in here, show how the revenues will change over time in the model, looking at the portion that's related for the company 8 pre-acquisition, and then any synergy gains that are resulting from the transaction. And then I also look at this graph looks into EBITDA. So it looks at the earnings before interest, tax, depreciation, amortization, and then any synergies that or any gains resulting from the transaction.
I hope you enjoyed this tutorial. If you have any questions or if you'd like to download the template used in the video, follow the link, which you will find in the description, or visit my website at www.challengejp.com. Thank you very much.